Let's jump right into this analysis because today we are tackling one of the absolute biggest debates in the financial world. We are breaking down the math, the psychology, and really the core philosophy behind exactly when and how you should invest your money. We're going to pit common wisdom right up against cold, hard historical data. So let's get into it. Look at this number right here, 89.2%. It's a genuinely terrifying figure, isn't it? This represents the sheer, staggering amount of market wealth that was just completely wiped out during the 1929 Great Depression. I mean, we're talking about the worst stock market crash in American history, an absolute unmitigated devastation of capital. To really wrap our heads around the gravity of that number, let's put it into some perspective. If you compare it to disasters we're a bit more familiar with, like the infamous 1999 dot-com crash with its 78% meltdown, or the 2008 global financial crisis that hovered around 54%, it becomes incredibly clear why 1929 earned the title The Great Depression. It delivered literally the heaviest blow imaginable to the market. And we're actually going to use this absolute worst-case scenario, as our ultimate stress test today. Which brings us to Section 1, the 1920 dilemma. Okay, imagine taking a little time travel trip back to the year 1920. You've got some cash, and you need to invest it over the next 40 years, meaning you're going to be riding straight through the biggest crash in human history. Now, you basically have two distinctly different paths here. First, there's regular investing, right? Dollar cost averaging. You don't overthink it, you just automatically invest a boring, steady $100 every single month for 40 years. Your second option is the highly debated buy the dip strategy. You stash your cash away, saving it up, and you only buy when the market crashes spectacularly. And let's even pretend for a second that you have this magical, supernatural ability to predict the exact market bottom right down to the millimeter. So here's the question. Which strategy actually wins? Does the boring, steady $100 a month win out? Or does waiting like a prophet to perfectly buy the absolute dip make you richer? Honestly, at first glance, buying the dip feels like the obvious, unbeatable answer. I mean, how could you possibly lose if you know exactly when the market is at its absolute lowest point? Well, here's the crazy part. When we run the computer simulations on this actual historical data, we get a highly, highly unexpected result. Consistent automated investing, just regular dollar cost averaging, actually crushes that miraculous, supernatural buy the dip strategy more than 70% of the time. Yeah, you heard that right. Even assuming you magically know the flawless, perfect bottom of the market, the boring monthly investor still usually ends up walking away with more money. Now, the real underlying question here is, why does this happen? Well, it's a bit like a giant puzzle. Because of that massive crash in the 1920s, buying the dip looks like a fantastic idea right at first. But by the time we hit the 1930s, the momentum shifts completely. While you're sitting there in cash, waiting for the sky to fall again, the market is often just rising. You're completely missing out on months, even years of growth and compound interest. Over time, the sheer upward momentum of the market makes the steady investor far, far more profitable than the market timer. Let's move to Section 2, the reality and the psychological costs. Because here's the harsh reality of the buy the dip strategy. Nobody actually has a crystal ball. Not a single mortal being can consistently, perfectly time the absolute bottom of the market. Let's say you try, but you miss the absolute perfect bottom by just 2 months. Just 2 months? If you're 2 months late to the recovery, the success rate of regular monthly dollar cost averaging skyrockets from 70% to an astounding 97%. Even if you think you're highly skilled at forecasting, trying to time the market will almost certainly cause you to lose out in the long run. While you're waiting on the sidelines with your cash saying, oh, it's going to drop any day now, the market just keeps enthusiastically climbing and you miss the train completely. Furthermore, there is an immense psychological cost to market timing. And honestly, we often forget this part when we're just staring at charts. When the stock market is actually crashing, when the world is legitimately panicking, and everyone around you is crying over their lost fortunes, it takes absolute nerves of steel to log into your account, hit that buy button, and risk your cash. It is incredibly, incredibly difficult to do in reality. Which leads us to Section 3, the $1 million question. So, if timing the market is a bad idea, what on earth should we do? Imagine someone just handed you a gift of $1 million, and you have to invest it. Again, you're faced with two paths. You could choose the lump sum strategy, taking the entire $1 million and investing it immediately, in one single shot without waiting. Or you could choose gradual DCA.
You decide to be incredibly cautious, investing just 1% of that money every year, essentially spreading the process out over an excruciating 100 years. And this brilliantly illustrates the logical fallacy of waiting around. If you believe the asset you're buying is going to appreciate in value, it makes perfect sense to put the money to work immediately. Holding cash for 100 years is a total nightmare because inflation will completely eat away its value. But hey, if waiting 100 years is absurd, then waiting 100 months or even 100 weeks to slowly trickle your money into the market is also logically flawed. Let's use a slightly more realistic example from the source data. Say you have $12,000. You could invest it all today as a lump sum or gradually invest $1,000 a month for 12 months. When we look at historical simulations using 24-month periods between 1960 and 2018, the result is crystal clear. Investing the lump sum immediately almost always outperforms spreading it out. In fact, if we pull the historical data back even further, I'm talking all the way back to the 1920s across massive market cycles, investing a lump sum immediately beats spreading the cash out 68% of the time. And if you're sitting there wondering if this is just true for the stock market, well, it's not. Across entirely different investment vehicles, the general rule holds true. Putting your money to work without delay yields higher returns. So the absolutely crucial point here is this. If you have a long-term horizon, waiting in cash for a crisis so you can buy cheap is historically a losing strategy. The train is moving, you are way better off getting on right now. A lump sum generally beats splitting your cash. And yes, if you have terrible luck and invest a lump sum on the exact eve of a massive crisis, you might be frustrated in the short term, for sure. But the long-term growth of the market will eventually close that gap and heal that wound. Now, after seeing all these numbers and computer simulations, you might still feel a bit hesitant. You might be asking, okay, the statistics make sense mathematically, but does this actually convince me to put all my money in right now? And that's totally fair. The data alone might not fully overcome that deeply ingrained human fear of a crash. So, to break down that final wall of doubt, we really need to look past the spreadsheets and take a much deeper philosophical perspective. Section 4. Investing in humanity. When you invest in a massive broad market fund that holds thousands of companies from all over the world, you kind of need to reframe what you're actually doing. You weren't just betting on a financial chart or some specific stock for a single year. You are making a fundamental bet on the human race itself. Just look back at the 20th century. We experienced the utter devastation of World War I, the horrors of World War II, the terrifying, agonizing decades of the Cold War, multiple massive financial crises, and markets that literally crumbled to the ground. Yet despite every single one of these seemingly apocalyptic events, humanity endured. We pushed forward, we innovated, we rebuilt, and we managed to progress. Ultimately, when you invest in the broad market, this is the core statement you're making. I believe humanity will be in a much better, more developed place in 10 or 20 years than it is today. It's a profound trust in the resilience, the drive, and the raw potential of our species to solve problems and create value. When you combine the unshakable historical statistics we just reviewed with this overarching confidence in human progress, the puzzle pieces finally fall perfectly into place. So I'll leave you with this final thought to ponder today. The math is absolutely clear. The history is written, but the ultimate decision relies entirely on your own perspective. When you look at the world, despite all its current flaws and fears, how much do you trust the future?